This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Chapter 11 deals with sampling. Well, I've already said that most auditing relies on taking samples of documents or samples of observation of controls operating, whatever it's going to be. And based on that sample, you are going to be drawing conclusions of what's called a population. Two risks what we're trying to deal with in all audit evidence. There is going to be sampling risk, the risk that we have had bad luck in our sample. We happen to pick documents which have all been perfectly handled, yet lying back there, the majority of them are actually incorrectly handled. They come to a wrong conclusion. Or if you remember, there was non-sampling risk, which was where even I looked at every document that the company had, because I'm not skilled, I don't have the training, I don't have the understanding, I'm wasting my time. And the way we got round the non-sampling risk was to plan to have the right caliber of people there, with the right training, the right experience, the right expertise and so on. Better people, if you like, and that they would be properly reviewed and their work double-checked by various people in the organization. But we're looking here at sampling. How do we go about sampling? What are the methods of sampling? And the types of sampling are this. Now, in mathematics, in statistics, if you are going to go from what will be called a sample result, and if you're going to be able to say something valid about the population, then what you require, that sort of sampling you require in here, is called statistical sampling. In other words, that simply means that it's valid according to the statistical theory. That the results can be quantified. We can say there's a 95% chance that the population lies within a certain range and so on. We can never get certain unless you look at 100% of things. But, a 95% chance that maybe the value of inventory lies between 1 and 1.5. No, that's a bit big. The 95% chance that the true value of inventory lies between 1 and 1.1 million, something of that sort. What statistical sampling means is that every item in the population has got an equal chance of being selected for the sample. Okay, so each item in the population equal chance of selection. And in particular, what this means is there is no sampling bias. There has been no way in which certain sorts of documents or certain sorts of transactions have been favoured, because once you introduce bias, you introduce a kind of distortion in the process, and you can't draw the conclusions in the same way as you could. So we're trying to get towards a position where every item in the population has got an equal chance of selection. And by far the purest, best way of sampling here is the first one, pure random sampling. That is definitely statistical sampling. Okay. How can we do it? Well, if let's say your 10,000 invoices numbered 1 to 10,000, you want to look at 100 of those. What you do is you create or generate 100 random numbers, and based on these random numbers, then you go and select that invoice. There's no bias in there. It's purely random. It's like a game of roulette. It's not you, the auditor, making some sort of decision over which one to get. And pure random sampling is the best. Think about these invoices, though. if these were sales invoices, we could number them as they were generated 1 to 10,000. We could do pure random sampling fairly easily. What, however, if they were purchase invoices? We might not number purchase invoices as they come in. They will have the supplier's invoice number on them, but we may not actually number them. And it could be a big job to go through and number 10,000 or 100,000 documents and transactions, just so we can do the random selection. So sometimes it's not that practical to do it. It's going to be a lot of work in numbering the members of the population before you can use random numbers to pick them. But it is the best if you can do it. Second method is systematic sampling, and systematic sampling is normally regarded as a very close and good approximation to pure statistical sampling. So we'll put an S in here. And what it means is you've got your 10,000 invoices kind of lined up in files, and we want, let's say, 100 of those. So that would mean looking at every 10,000, every 100th invoice, wouldn't it, roughly speaking? So what you would do is you would pick out of your first 100, pick a random starting one. Let's say it's invoice, 60. So you pick invoice 60, and then you kind of count through, pick invoice 160, count through, pick invoice 260, and so on. You go up in a systematic way, a constant gap between each document. And provided that the invoices from your suppliers hadn't been filed in some peculiar way, they were filed just as they came in through time, then the chances are you're going to get a really quite a good selection from these invoices, not favouring one particular supplier over others, and so on. Obviously, you have to be a little bit careful if you're looking at amounts being paid into the bank. Let's say you pay in 5 days a week. There, you wouldn't want to be going through the pay-in slips, let's say, every 10th one, because every 10th one would always land on a Tuesday. But provided there's no particular pattern within the documents, systematic sampling is a very good method. Haphazard sampling. Haphazard sampling is not regarded as statistical, so we'll put in here a non-statistical way, although I think it has to be admitted that it's a method of sampling that's perhaps used when it shouldn't be. What haphazard sampling would mean is if you picture here as your file of suppliers' invoices, you kind of close your eyes and you kind of stick your finger in at random, really. So, I'll pick that one. And then you close it up again and you kind of go fumble through again and you open it again and you try to open it at random. Very quick to do. What are its dangers? Well, the dangers are that, not all documents are equal. Some might be physically larger, and when you're kind of fumbling through here to find out where the file opens or to find your document, you're more likely to put your hand on the big invoice, the physically big invoice, and they tend to be maybe from one supplier. Or maybe your favourite colour is green, so subconsciously you pick the green invoices. Or even worse, what happens, and this is really the slippery slope to really bad auditing. So Friday afternoon, you're about to leave the client and finish the audit. You just have to pick 20 invoices to make sure they've all been approved. And you go in with your random sampling or your haphazard sampling, and you say, my last invoice here, oh, goodness me, it hasn't been approved. And you say, well, this was a random sample, and I could just as easily have picked another one, And that shouldn't happen, Obviously that shouldn't happen. You should say this invoice wasn't approved, and you should take the consequences of that maybe we can't rely on that form of internal control. But once you put that human judgment in there, you're on a potential kind of slippery slope towards sampling which is very biased and not very reliable. Sequence of block selection isn't going to be very useful to us. Basically what it is, you would take maybe 20 invoices all together in the file, the chances are in most systems those 20 invoices will all have been dealt with on one day. So you're not getting a very good spread throughout the period and so on. So normally that would be non-systematic. Monetary unit sampling I'll deal with in a moment over the next slide. Stratification is quite an interesting one. Quite often, if let's say you're looking at your receivables balances, you've got 10 customers who've got a balance of maybe more than, let's say more than 100,000, really big kind of key customers. You maybe have 20 customers who are kind of between 50,000 and 100,000. And then you've got lots of little fiddly customers, let's say 300 customers whose invoices or balances are less than 50,000. Now, and you're doing a random sample of 20 invoices. Do you see there's a really good chance that in this random sample you will not pick any of the big balances? Picking 20 out of this here, about 330, the chances are that you quite often only end up with the small balances. They're far more common. Wouldn't you just hate that? Wouldn't you feel almost cheated by the sampling system that you'd not been able to verify directly what might be quite a high value of the total receivables? So what stratification does is to say, right, I will maybe sample all of those, and then what I will do, I will maybe sample half of those, and then maybe what I'll do, I will sample 20 of these. So a sample is going to be 40 items, but we're ensuring we get all the really big ones. Is this valid statistical or not? Yes, it is. Because what we can say is, I want to sample my big invoices, my big balances. I'll do all of those. I also want to sample my medium ones. I'll do that randomly. And I also want to look at my small balances. I want to do tests on those, and I'll select those 20 randomly as well. Provided that you look at all the strata and you select within those strata on a random basis, you're okay. Another way of thinking of it is, I could have ended up in my, let's say, a sample of 20, purely random, only taking this 20. We're not hurting the evidence anymore by saying, well as that, I'll take all of these and taking half of those. So stratification, very important way of making sure you cover a high volume, but nevertheless, within the detail, you can be maintaining your approach to random sampling. What you can't do here is to say, I'll just look at the big ones. Because if we just look at the big ones, and of course the big important customers are the ones you might deal with properly, whereas the relatively small customers here are the ones you might be dealing carelessly with, and this is maybe where the errors are. You can't leave out a subsection of the data. Monetary unit sampling. This is also a statistical method of sampling, and it's a little bit complicated, and it's something where if the auditors are employing what are called computer-assisted audit techniques, the computer assistant makes it much easier. Imagine here what we have is a list of customers' balances. So this is basically debit balances within this. And we've got here our, whatever it is, 10, 12 customers. The next column, and of course what we could do is we could choose 4 of them. Let's say we want 4 of them. We could choose 4 of them at random. But there's a very good chance that we would say miss the 2 very large ones here, the 1600 in here and the 1010. We've got quite a lot of small ones, 20, 50, 30, 80 and so on. If you just chose 4 at random, there's really quite a good chance that you would miss the big ones and get all the small ones, which is kind of not maybe just what we want. Nevertheless, we don't want bias to be in it either. So what monetary unit sampling does, it says instead of selecting for customers at random, it says let's select 4 amounts at random, 4 monetary amounts at random. So what we've got here is a cumulative. So 80 plus 170, 80 plus 70, 150, 150 plus that, and so on. So we know that just going down here getting cumulative balances, our total receivables is that. We've decided that we want a small sample of just 4 for this example. So what I've done up here, instead of taking 5110 just for convenience, I've really said, well, it's as near as matters to 5,000. We will divide the total monetary amount by 4. So here, by taking 5110, changing to 5,000, nice round number, 1250. And what we're going to do is now becomes almost a kind of systematic sampling. Instead of going up every second or every third or every fourth customer, we're going up the amounts in jumps of 1250. So the first, if you like, section of that is going to be from 1 to 1250, and we choose something at random within that. And I've said, let's pretend it's 605. So we're looking for the amount of 605, and it is going to fall in here somewhere. That's 550. At the end of this third customer at 550, the 605 is occurring somewhere within this customer here. So we would pick that customer. That's where 605 is. And then what we're going to do is, for the next one, we're going to jump forward, not a number of customers, we're going to jump forward 1250 worth in money. So this here, plus 1250, is going to get us to 1855. And we see where in this cumulative money does 1855 occur, and it must occur in this customer. That gets us to 640 at the end of this customer at 2240. The 1855 is in there, so we'll choose that one. And then what we're going to do is we're going to take the 1855 and leap forward another 1250. That's going to take us up to 3105, and this person here will be chosen because that 3105 occurs just after this customer here, and we'll be in there. And then finally, to get our fourth one, another plus 1250. That's going to bring us up to 1355, and this one is going to be in here somewhere. Do you see that because we're going up in values, the chances are that we're going to land on a customer who owes a lot to us, because that customer, if you like, rules over a large range of values. So this customer here who, here, big customer owing us 1600, if you like, we've got, kind of 1600 chances of landing on that value and choosing the big customer, whereas we've got only really a very small chance of actually landing on that customer who only owes us 20, So we're aiming at a, 20 or 1600. We're going to favour landing on customers who owe us a lot, and we're going to less probability of landing on customers who owe us a small amount. Yet it's all objective. It's taken out of our hands. There can be no bias on this. There is a chance of landing on both large and small customers. We've just skewed it slightly so that we can cover a lot of ground in our sample. We get a lot of value covered in our sample. And that is monetary unit sampling. Don't worry about it too much. You wouldn't be asked to do any calculations on it. It's just to know what it is. Size of sampling here. Remember, say it again here, these two sorts of risk. We can reduce the sampling risk by increasing the sample size. And typically what happens is if you were to choose 20 invoices, making sure they were approved, you find 2 out of the 20 were not approved. You're wondering, is that just kind of 2 items pretty isolated, or is this indication that maybe 10% of all invoices are not approved? Then, having chosen your 20 invoices at random, you get a slightly ambiguous result. You then say, well, let's choose another 20 at random to see whether those 2 were pretty isolated, those 2 exceptions were very isolated, or whether this kind of problem is more endemic. So if there's something that causes a bit of concern in your random sample, then you can increase it and investigate a little bit further to see where it leads. You can take 2 sorts of error within it. If we're looking here at a test of control, we can have under-reliance on it. We can be picking our 20 invoices. We find 5 have not been properly approved, and we therefore maybe conclude that the control is not to be trusted, but those might be the only 5 out of 10,000 that were not approved. Or we could look at our 20 invoices, all have been approved, but there's quite a substantial proportion in the population which haven't been approved, and we simply haven't detected those by sampling. So there can be under-reliance and over-reliance always in sampling, and all of these errors, these 2 types of errors, are reduced by increasing your sample size. Similarly, in substantive procedures, if we were looking at 20 items of inventory to make sure that they were valued correctly, we can find errors both ways. We could reject them. We could look at our 20 items of inventory, say those 5 that picked up the wrong purchase prices for those that had been valued incorrectly, therefore I will kind of conclude I can't believe any of the items. Or what you might say is my 20 items of inventory, I can trace them all back to the purchase invoices. They've all been correctly valued, and you could accept the value of inventory when in fact there were many other errors lurking beneath the surface.